Good afternoon, ladies and gentlemen. A very warm welcome to you back on Business Radio Television. We are in the business of creating quality portfolios, especially in the mutual fund space, which can be utilized to create not only long-term wealth, but also get a sense of direction where the markets are headed in terms of where fresh money is flowing into and what top quality advisors are telling their HNI clients. We are now joined by Ms. Shweta Rajani, mutual fund head at Anand Rathi Wealth Limited. She's been with this wealth company for the last 12 years or so. Okay. She's been with Anand Rathi Wealth for the last 12 years or so, and we will be discussing long-term portfolios, medium-term outlook on the markets, and most importantly, what should you do with your gold and silver investments if you've come into the party really late and you are getting a little bit worried as to where silver and gold could be headed. Shweta joins us. As I was telling our viewers, Shweta, you've been with Anand Rathi Wealth for the last 12 years or so and have earlier worked with Religare Securities too. A very warm welcome to you. First off, imagine a person who's entered silver ETFs above 350 rupees per unit and gold ETFs at 160, 170 rupees per unit. What would your advice be to such a investor who's really now bothered?
Perfect. Good afternoon. So first up, it's important as to why you have that gold or silver in your portfolio. If you had it as a risk mitigant, then that's not the right asset class for you, because gold and silver will have the same volatility as equity would be. But equity would have the return potential, which would be little more than probably gold and silver can give you over a 5-7 year time period. So my, looking at how the volatility has been recently, I would say your majority of the portfolio still should be equity heavy. Gold is better than silver from a volatility perspective as well as a slightly long-term perspective. So if you can consolidate, have gold, no problem to a little extent in the portfolio, have debt, have equity.
Let me just rephrase this question a little better, Shweta. Maybe I wasn't able to put my view forth. I'm asking what should an investor do if his or her gold and silver ETFs are bleeding losses at this point of time? Average lower, hope for the best. Will these prices come back?
So would the prices come back? Yes, they would come back. The only question is going to be when would it come back and what would be your opportunity, loss or gain if you continue to be with that asset class. So which is where, if I have to look at it in terms of, silver is more driven by industrial demand. And right now there has been some amount of an industrial demand over the last few years, which is where we saw an upside in the silver prices. Of course, can there be other metals which can also take over silver? That can come in. So yeah, hold on for the next few months, but that's not an asset class which I would ideally build from a long-term perspective. So if you can shift from silver to gold, that would be a better choice. Not now. Hold on. Right now it's going through an excessive downside volatility. Let it stabilize a little. And then shifting out to gold or equity to recover if there is any residual loss may be a better choice.
Okay. From what I understand, for those wanting to get a precious metal exposure, go for gold ETFs at this point via a SIP format, Shweta?
Yes, but it is important to understand that gold should not be something that is, an option or an alternative to the equity portion of your portfolio. If you are replacing debt with gold, then you can have it. You can build it in the SIP form if you have money which is coming in on a regular basis. So like if you have your salary and then that portion of it has to go in gold, then do an SIP. Else, I would say stagger your investments maybe for the next 4 to 6 weeks if you have some lump sum sitting in your bank account, and go full up with your allocation.
Fair point. at this point of time, suppose you're starting afresh, what should be the silver to gold ratio in your overall broad portfolio, and what should be within silver and gold more weightage given to?
Okay, I'm going to break it up a little more to first say that on your overall asset allocation basis, you will have, clearly debt, equity, and commodity. Those are the three asset classes which you would use to build your portfolio. I'm assuming you have a long-term time period of investing. So you have 5 years plus as your investment horizon. In such a situation, equity will clearly be that asset class which can be the growth-oriented asset class. So there you can have, depending on your risk profile, anywhere between a 60 to 80% allocation towards equity. You're left with gold and commodities in there now. These are, gold and silver. Both, I would say, will be in between from a return standpoint. They'll give you returns better than debt. They'll over this time period, as we've seen historically also, they may have a performance which may be slightly lower than that of equity. Volatility, if I measure it in terms of your standard deviation, your volatility would be something which will be closer to an equity volatility. So for whatever money you were supposed to put in gold, you can split that half into whatever money you were supposed to put in debt. Let's say that's 20%. I would say split that half between gold and commodities. Between the rest, let's say you're putting 10% in commodities. I would say my preference there would be to go with gold rather than silver.
Okay, now this is what I have understood. Suppose you have a 1 lakh rupees to invest on a monthly basis for the long term. Minimum horizon is 5 years. Okay, between 60 to 80% is equity, diversified mutual funds. We'll get to this a little later. Now, for the amount of debt that you were trying to put in, instead of debt, go for gold plus commodities. Am I right?
That's right.
Okay.
So whatever you're supposed to put in debt, split equally between gold and debt.
Okay, I get you. So if overall debt were 20% of your portfolio, it should be 10, and 10 should go towards gold. Am I right?
Absolutely.
Perfect. Okay. Now comes the most interesting part, for which I have spent many decades researching. Where should you put in fresh money when it comes to equity mutual funds? Again, the thesis is the same. More than 7 years is the investment horizon. We have patience, and we'd like to invest between 50,000 rupees to 1 lakh rupees a month, creating a fresh portfolio of equity given what is around us.
Sure. So here again, before I get into the specific schemes, I'm actually going to break it up into what should be your market cap mix that you should have. How much of large, mid, small in the portfolio. I'm going to talk about 2-3 factors over here. So, looking at the profit growth expectation, the valuation, and how today the liquidity is flowing amongst these 3 segments, clearly there is a potential, given the way valuations are. All of your 3 segments today are, I would say, fairly priced. It's not an overstretched valuation. Even with the kind of correction we've seen in mid and small cap right now, they're sitting in a fair value zone. Talking about the profit growth, we've already seen the first 6 months where 100% of the result has come in. Large caps have been at around 8-9% profit growth, mid caps at 16 to 17%, small caps at around 10-11% profit growth. So both mid-small segment can have a significant allocation in your portfolio, looking at both the forecasts for profits as well as the valuations. I would say if I have to construct a portfolio, I'd go with a portfolio which has maybe around 55-ish large and a 45 mid small, which is equally split today between a mid and a small cap portfolio. With this context.
Yeah, please go ahead.
So with this context, now if I have to look at the categories of funds, I can look at pure large cap or a flexi cap to have my large cap exposure. So I would go with a 1 large cap, 1 flexi cap fund. I'll take a mid cap fund, 1 small cap fund, and a multi cap fund to build my portfolio from a 5-7 year perspective.
Okay, so this is what I've gathered. Suppose you have you have, let's make it a round number, 1 lakh rupees to invest on a monthly basis. You can either reduce the amount but keep the percentages steady, and or increase the amount, that would be wonderful, and keep the percentages steady. So 20% goes to gold plus debt. Of the 80%, ladies and gentlemen, 55% of 80 should be a large cap plus a flexi cap fund, and then you can have a mid cap plus a multi cap fund. So far so good, Shweta? We are on the track?
Yes, that's how.
Okay. Now, what I have noticed right in front of my eyes is that you missed small caps. Is it on purpose or you want to stay away?
No. So you can have a mid cap fund, a small cap fund, and a multi cap fund through which you will get your mid and small cap exposure.
Okay.
So I talked about having 5 categories: a large
Correct.
cap, a flexi cap, to get the large cap exposure, because nowadays even flexi cap funds have 70 to 75% of the portfolio in the top 100 companies, which are called as large caps.
Fair point.
Multi caps have around 50 to 60% of mid and small cap. So
Okay.
that's how, and have one pure mid and one pure small.
Perfect. Now, ladies and gentlemen, this is a very, very interesting discussion which is heading in the right direction. We've discussed asset allocation, which is equity, gold and debt. Within equity, now we are discussing what to buy, and remember, all of this is for the long term. Please remember, in the blink of an eye, time passes. This is my 33rd year in the markets. I don't know how that has lapsed, and I can tell you some funds that I have purchased for 10, 12, 13 rupees are now more than 2,000 rupees in terms of net asset value. So you can have as many multi-baggers in your portfolio provided you have patience. Now we are identifying these multi-baggers. You have to ensure that you put in 1 lakh rupees a month in these funds. Okay, Shweta, now the responsibility of creating long-term wealth is heavier on your shoulders. Let's take it forward. Give me 2 large cap funds and 2 flexi cap funds that you like.
Perfect. So before I get onto the schemes, I'm also going to highlight some of the factors that I would have looked at, and we, as a group look at, and to my mind, every investor should consider these. And it's not just looking at the past returns of the fund while you're taking your investment decision. A lot of investors go with that. I'll give you some data point. Analysis shows that a fund which may have been in the top quartile in the last 6 months, there's only a 25% chance that it will continue to be in the top quartile in the next 6 months or the next 1 year. So you have to look at factors which would be beyond past returns when you're taking your decision. It has to be, looking at how the portfolio is constructed today and what's the underlying potential of that portfolio for the next 1-2 years. The fund manager's stock picking capability, how actively the fund is managed. And then, after looking at few other factors, but these are the bare minimum factors you should look at before you invest. Few funds, which if I have to say, you asked me for 2 schemes, I would say, if I have to look at a large cap category, I would just pick one over there. I'll say a Quant Large Cap. I will merge maybe a dividend yield as a category, because that's another large cap heavy category.
I'm so sorry, Shweta, we didn't catch the name. Which large cap fund are you talking about?
I spoke about a Quant Large Cap fund that you can go ahead with in the portfolio. You can have, if you have to take another large cap fund, you can go in for a Nippon Large Cap fund, or alternative is in the dividend yield category, which are also large cap heavies, and ICICI Pru Dividend Yield as a large cap substitute. In the flexi cap category, if I have to pick, I would say go in for an HDFC Flexi Cap fund. That would be, 3 or 4 choices between large cap heavy categories.
I'm embarrassed to again tell you that I missed the first fund that you mentioned.
I spoke about Quant mutual funds, Quant Large Cap,
Perfect.
the Nippon Large Cap, ICICI Dividend Yield, and HDFC Flexi Cap.
Fair point. My apologies, I made you repeat that. Why would you choose a dividend yield fund at this point of time, ma'am?
See, if you look at the dividend yield as a category, also there have been large cap heavy. One, because if you look at how historically their underlying portfolios have been, anywhere between 65 to 75, 80% of their portfolios are also investing in large cap. So it becomes a quasi large cap category. Plus, they benefit from a dividend yield also coming in, which most of these funds will have anywhere between 2.5 to 3% of the return coming in from the dividend yield. It in the large cap category, it can bring in one different style of investing where you may have a pure large cap fund like a Quant or a Nippon, which is chasing your growth oriented companies. This brings in a different style of investing while giving you the underlying large cap exposure.
Fair point. I just want to clarify, ladies and gentlemen, when we talk of a dividend yield fund, it's not as if that the fund will be paying you a dividend. You are going to use the direct and the growth route there. It's just that the stock picking character of the fund is that they look at assets which give you relatively high dividend payouts. It's a marketing thing, but it's not a fund that you're going to get at as something that pays you dividend. Okay, so now we've taken care of 55% of 80%, Shweta, where we have a choice between 3 large caps and 1 flexi cap. Perfect. Now let's come to the second category where 45% of 80% will reside, which is mid cap or a small cap plus a multi cap. Now here you'll have to give us multiple options. Please go ahead. Let's start with the quality mid cap funds which you find comfortable at current levels.
Sure. So, here I would say you can go in for a Kotak Mid Cap fund. Of course, been there, gone through different cycles, and it's displayed consistency. So, if I'm looking for a quality mid cap, I would go in for Kotak Mid Cap. I will, there can be another alternative of an HDFC mid cap, but I would prefer an HDFC small cap than an HDFC mid cap of the same fund manager, Chirag Setalwat. So
Yes.
you can opt for one of those, but I would prefer going in for a Kotak mid cap and an HDFC small cap in my portfolio.
Okay. Now this is one combination. Give us maybe 2 or more combinations of a mid small, small mid.
Sure. The other combination I would go in for would be again a Kotak mid cap with an Invesco small cap. That again
Yes.
is a good combination to have. Whether I look at the balancing out it brings in terms of the styles, a mix of growth and quality portfolios coming in together.
Okay. So folks, we have a choice between HDFC small cap and Invesco small cap. Kotak mid cap remains constant. So that's about 22.5% of 80%. Okay. Now let's look at the multi cap series. Multi cap series, ladies and gentlemen, is more important because here the fund manager has the flexibility not only across equity asset classes, but they can put in money in gold and silver as well. Shweta, please go ahead. Your top 3 multi-cap picks.
Yeah. So just here, these are multi-caps. So ideally what they will do is have minimum 25% each in large, mid, small. The rest 25% is the flexibility that's there with the fund manager to invest within these 3 market caps the way they want to. My suggestion or my pick here would be to go in for a combination of a Kotak multi-cap and a Canara Robeco multi-cap. Canara Robeco multi-cap follows a growth-oriented style, so they will invest in underlying companies which have a higher growth potential. And then you have a Kotak multi-cap which kind of follows growth at reasonable price kind of a concept. So you're getting a good mix of different fund manager styles coming into your portfolio. So the diversity of the fund manager styles will also ensure the risk is being managed well and you're creating an all-season kind of a portfolio.
Okay, fair point. That's 2. One more.
The third multi-cap fund, if I so have to choose, I may want to go in for a Bandhan Multi Cap fund.
Okay. Bandhan Multi Cap. Perfect. So that, ladies and gentlemen, is the overall portfolio. Again, if you have a lakh of rupees to invest, about 20% of that should go into gold plus commodities. Of the remaining 80%, go for 55% for large cap plus a flexi cap fund. Best quality large cap funds, according to Shweta, are Quant Large Cap Fund, Nippon Large Cap Fund, and ICICI Pru Dividend Yield Fund. You can choose 2 or 1 from these, plus one flexi cap fund, which, ladies and gentlemen, is HDFC Flexi Cap Fund. When Shweta was in school, it was called HDFC Equity Fund. Yours truly is a unit holder in that from 14 rupees. So you can well imagine the kind of wealth that has been created simply because I did not sell. Please note. Then the remaining 45%, ladies and gentlemen, should go into a mid cap plus one small cap plus one multi cap. Okay. Best quality mid cap funds are Kotak Mid Cap. Despite my repeated efforts, Shweta has stuck to just one mid cap fund. Okay. And within small caps, you have a choice between HDFC Small Cap and Invesco Small Cap. 22.5% money should go into a multi cap fund, which Kotak Multi Cap, Canara Robeco Multi Cap, Bandhan Multi Cap. Try to have 2 of these. That, ladies and gentlemen, is the structure of how you should build a good quality mutual fund portfolio given the circumstances that we are here. Now, hear me out. What are the things and hurdles that we've passed? The Indo-US trade deal, while the fine print is still not known, is out of our way. RBI credit policy is out of our way. The Indo-EU trade deal is in place. The national budget is in place. Now, it is only a question of earnings kicking in, and Shweta's stock picking or fund picking points to quality mid caps which are in these portfolios based on the kind of earnings they have put in. She's already advised you on gold and silver. One thing I realized, Shweta, debt is completely missing. Why is that?
So, see, debt in the portfolio brings in stability. Of course, you're compromising on return because what you would end up is somewhere around a 6.5%. If you are in the lowest tax bracket, if you're in the largest tax bracket, that's going to come down to maybe around 4.5% for you. But it brings in stability, so it serves the purpose of risk management. If you have a shorter term horizon, then you need more stability. Then I'd say you can have a higher debt allocation. But there's enough data to show that if you have holding periods which are 7 years, 10 years, equity, can give you more than debt clearly. But since you've asked, I would say, if you have that shorter horizon and you want to go in for a debt fund, you can go in for categories like maybe an arbitrage. It would still give you the spread would be around 6.5, and it may end up giving you a equity or life taxation if you hold it for more than a year. Or you can go in for categories which are debt plus income categories. There again, the taxation is slightly better. So those are a few of the categories you can look at. Funds, you can go in for an SBI arbitrage or HDFC arbitrage. Likewise, in the debt plus income categories, if you want to go in for, then you can take maybe an ICICI or the HDFC one over there.
Okay, fair point. And my final question to you, Shweta, is that we seem to have missed out the entire international global fund space. Ladies and gentlemen, I want you to hold your breath and look at the stunning return that Nippon Taiwan ETF has given in 1 year. It is up more than 50%. So international funds have to be a part of your portfolio, especially when there are more than just enough question marks on Indian corporate earnings growth. So, Shweta, your favorite 3 international funds, it could be an ETF, it could be a small sized corpus, or it could be whatever you prefer.
Sure. So I actually have a slightly different view here, and I would say have an international fund in your portfolio only if you know that you would need that dollar investment in future. Given that you may have your children moving in for education, or for work purposes, but you will need those dollar investments. If that's not the case, then to my mind, I would say for the next few years, not talking about how the last 1 or 2 years have been, where you have, US, Taiwan, US markets performed way better than how the Indian market has performed, and the rupee depreciation to USD has also been around 7% for the last 1 year. But if I am having a forward-looking approach, and I'm talking about the next 3-4 years, looking at where the nominal growth of India would be versus the other countries, we're talking about 10% versus the world average being at 3.5-4%. Rupee depreciation averaging out to maybe around 2.5-3%, which I would say being in Indian equities may be a better choice for you. However, if you have to build an international exposure, I would say, while there may be an interim volatility that you see, but a US equity exposure, not tech, not specific sector oriented, but a broader S&P 500 kind of an ETF may be a better choice to go for.
Fair point. Just to bring in another point, how old I am. When I started working, Shweta, the rupee to dollar was 23. And we are now at 92. So that's free money. Because if you buy a US or any ETF which is investing in overseas markets, ladies and gentlemen, the rupee depreciation benefit versus that currency is the free bonus that you get every year. Plus the kind of money that fund would have made. Be that as it may. So that's a broad S&P 500 ETF which you should be looking at. Any names that you can suggest? Maybe Mirai Top 50?
Yeah, you can go in for a Mirai, fund, or ICICI also has a US equity fund.
Yes, it does.
Equity.
Yes.
You can go in for either of those. One is an ETF, one is in kind of an actively managed fund. So
yes, US Blue Chip is an actively management fund from ICICI Pru. Wonderful.
Yes.
What a pleasure and what an interesting conversation, Shweta. Thank you for your time and with such wonderfully incisive and deep thoughts on where you should be putting in money. Have a nice day and we look forward to welcoming you again. Next time we are going to discuss how to create passive income by investing via systematic withdrawal plans in the money that you've already earned over a long period of time to have a happy retired life. Stay tuned. That, ladies and gentlemen, was Shweta Rajani, the head of mutual fund investments at Anand Rathi Wealth. She advises a lot of ultra HNI clients to create long-term wealth by doing as little as possible and doing it in a very patient and sensible manner. Thank you for watching.